As investors, Philip, obviously we're always looking for lines of sight into the consumer and how they're holding up. You say here, consumers are not to be trusted on the economy. What do you mean by that, Philip?
Well, so consumer sentiment has delivered a number of false alarms the last few years. Remember the inevitable recession that never arrived? A lot of times it was pinned on consumer sentiment, which was very low. But in the end, consumers are pretty good at judging their own finances. So if you ask them how they're feeling about their own finances, 75% say pretty good or even good. But if you ask them to judge the economy, suddenly they say only 25% say the economy is doing well.
Why is that, Philip?
Well, I think a lot of it has to do with observability of facts. You know what's on your payslip, you know what's going in and out of your bank account, but why would the average person in the street know much about how the economy is doing? So they're substituting observability with pessimism, right?
Yeah.
So pessimism, where does that come from? Well, it comes from media, social media. Does come
Always
from
the media.
TikTok.
It always comes out of the media, Philip. I get it. But that is interesting. Also, and I want to get your take on this when we talk about sentiment readings, you also often hear people say there is a political element to it, correct?
I think that's fair. So if you look at consumer sentiment by party affiliation, it's very clear that it's really a political proxy. Like, which party do you vote for?
Yeah.
I mean, just an example, inflation expectations. So Republicans this year consistently said inflation would be as low as 1%. At some point, they even thought it was negative, prices will be falling. And Democrats thought, well, and continue to say inflation will be as high as 10 or 11%. Well, neither of these numbers is remotely credible, right? And unfortunately, it's not like you can just add them up and divide them by 2, get an average, right? You can't get at a bipartisan reading by averaging them out. If you add 1 and 10%, it's 11 by 2 is 5.5. So 5.5% inflation is too high. It's outside the range of what's plausibly playing out this year, as we saw this morning. Yeah.
So what do you, let me ask you, what do you do with these sentiment indicators? Do I ignore them? How should I approach them?
So I've been telling clients for the last few years, don't listen to what consumers say, watch what they're doing with their money. Right? You can look at consumer spending.
So just focus on what they're actually doing.
What they're actually doing. And if you look at household spending, if you look at retail, I mean, household consumption's been a straight line up since, the first COVID dip and the bounce back. It's just been a straight line higher all the way through. A little wiggles here and there, but basically a straight line up. Totally flying in the face of what consumer sentiment surveys said all through those 2-3 years that we've gone through.
And when we talk about the consumer, Philip, oftentimes we talk about it like it's one consumer, but of course, low income, middle, high income. As an economist, how healthy, how resilient are the consumers right now?
Well, I mean, wherever you look, I think you see a lot of evidence that consumers continue to be rather strong. Just think about earnings this morning, big banks reported. There's very little, there's nothing really in the earnings reports at all that suggests that there's a crack in the US consumer. In fact, if you look at the big banks, charge-offs were below expectations, so you don't see that stress in the credit space for consumers. And so I think that is just one piece of evidence. Evidently, spending continues to be robust. The job market, above all, is really where spending is getting its sources from. So, as long as the job market holds up, I think we're going to see
the kind of what we've heard about the job market, right? It's sort of characterized by a lot of economists who come on the show, Philip, is sort of cooling, not crashing. I'm curious, as you look out in the quarters ahead, is that the trend you see continuing?
Yeah, I think the labor market will hold up. I mean, it came off these extremely strong numbers. We had payrolls and many hundreds of thousands, remember, 23, 22, et cetera. That has cooled, but it's still a respectable pace of hiring. And as long as we add these paychecks to the economy every month at a reasonable clip, consumers will continue to spend. I think we're overthinking it a little too much when we're asking them to look out many years and what are their expectations of inflation, et cetera. They're essentially spending what's coming in. And as long as we're adding jobs and as long as real wage growth is positive, and it is positive, I think that will continue to prop up consumption.
As long as I have you, Philip, let me get your take on that June CPI report.
Sure. I mean, look, I've seen some coverage that suggests, look, 2.7, that's really high, and it's higher than it's been. But look, if you take a closer look at this, the year-over-year number, 2.7. So June 2024 was a very low base period. So to me, the year-over-year number really is driven by what was a year ago. You had very, very little, had a very weak print then. If you look at the month-over-month numbers, they're fine. Right? So the headline month-over-month number is 0.3, in line with expectations. And the core number was 0.2. It's a tenth below expectations. So it's not really possible to say that this is a bad CPI print at all.
What do you think the Fed made of that report?
Well, I mean, look, the Fed is just going to sit on its hands, I think, continue to do that for a while. You don't have a reason to rush to a cut. The economy is holding up. The resilience is pretty strong. Consumers keep spending. So I think this is not going to change that part of the equation.
All right, Philipp, great to see you. Great to have you on set, sir. Thank you.
Thank you for having me.
Fresh economic data coming in on Tuesday with June's consumer price index, and tariff proponents may have some explaining to do when it comes to the uptick in inflation. Joining me now is Yahoo Finance senior columnist Rick Newman. Rick.
Hey, Josh. Well, Trump talked to reporters outside the White House today. He said inflation is very low. I guess your guest who we just had, I buy what he said, 2.7%. That's nothing to freak out about, but it's going in the wrong direction. And economists who have been scouring this data, looking for signs that Trump's tariffs are finally pushing prices up, are now finding evidence that the tariffs are pushing prices up. And you can see that if you look at specific product categories that are dominated by imports, such as appliances, such as sporting goods, such as toys. Much of that comes from China or other countries in Asia. And we did see big month-to-month jumps in those categories. You can see some of the charts there. I mean, it might be a little bit hard to read, but in other categories such as clothing and furniture and footwear, we did see the trend of prior months, which was basically no inflation. Now we're starting to get some inflation there. And that is basically exactly what economists say would normally happen when you start raising the tax on imports. So if this continues for a few more months, I think it's going to be very clear we do have tariff inflation. Given all that, economists think that the Trump tariffs as they stand now, that might raise inflation from 2.7% now to, let's say, 3.5%, maybe 4%. So that's a lot lower than the 9% we had in 2022. But will voters notice? I think the answer is some will and some won't. And Trump is going to have to persuade them that even though inflation is going up, it's not a problem.
It was interesting, Rick, because some economists were kind of focusing on the goods categories, and I saw other economists, they were making a beeline for the services, and the disinflation they saw there. They were pointing to airline fares and auto insurance premiums and shelter costs. You mentioned the politics of this, Rick. Just elaborate on this a little bit for us. How do you see that shaking out for the Trump White House?
Well, Democrats are sounding hysterical, frankly. So every time there's like a 1/10 of an increase in the price of anything, they shout that Trump is it's driving inflation up and nobody can afford anything. I mean, that's not true. I mean, inflation is not that bad. But on the other hand, we got as low. So just to go through the recent history here, everybody hated 9% inflation in 2022. Almost everybody saw that, whether it was food at the grocery store, gasoline, almost most things people buy. We got that down to 2.3%. That was the low point earlier this year. And the Federal Reserve, of course, wants to see it around 2%. So we almost got to 2%, and now we're not. Now we're going the wrong direction. So, Trump keeps screaming at Federal Reserve Chair Jerome Powell to cut interest rates, but it is Trump's own tariffs that are preventing Powell from cutting rates. So this is all a blame game. Trump is preparing. He wants to have a villain ready to finger if the economy does turn south. Democrats are already, they've been screaming almost since the day Trump got into office that he's ruining everything in the economy he touches. Nobody's exactly right. And I think that it really depends on where does the pain really fall. But it will fall more heavily on working and lower income Americans, working class, I should say, than anybody else, because that's what always happens. And of course, that's a big part of Trump's base. So I think he knows he's going to have to tread carefully here.
Rick, thank you, my friend. Appreciate it.
Hey, Josh.